Welcome to the Happy Hour Money Podcast. I'm one of your hosts, Josh Bennett. As per usual, I'm with my co-host, Isaiah Douglas. Welcome, Isaiah.
Welcome, Josh. Welcome, everyone tuning in. And I'm going to give a quick disclaimer here at the beginning. You might want to, pause if you're usually listening to this on an audio format and go to YouTube and watch this because we're going to bring a lot of visuals and we'll try to chat through what we're showing, but I also don't want to make it horrendously boring for those on YouTube that are like, yeah, I can see what you're talking about, Josh. I can see what you're talking about, Isaiah. Right. So if you're in the car and you have to, it'll still be good stuff. But I think ideally you want to watch this one. So other than that, we can kind of get rolling. But
to dive in what we're looking at, we are going to actually be chatting through sort of a reflection on the 2022 year of investments, macro environment, everything that kind of happened in the world in terms of money for 2022. So looking at a mirror and also, inevitably talking through what that means for the future. I mean, as much as we can tell without our crystal balls. So there's gonna be a lot of charts and stuff showing, what happened this year. So that's kind of what you might want to tune into. Just might give a little bit more clarity. And, that way you also know we're not just sitting here, talking our mouths off without any real data to back it. But cool. Yeah. I mean, so I think one of the areas we wanted to start in, I think it just, start at the top, talking through some of the macro environment and what went on just in the world economy as a whole. And then we can start sort of narrowing it down to different, more niche aspects of the world. But yeah, so you want to jump into sort of some macro trends you're seeing, Isaiah?
Yeah. So the first chart that I want to show and kind of tweet that has a chart in it, right? So I think, Twitter, when filtered correctly, can have some really interesting stuff. And this was a chart that's been floating around quite a bit. And what it's really interesting is, 2022 awful for stocks and bonds. And the reason why I wanted to start here is just because you think about the average investment portfolio, and we've chatted on this in previous episodes, right? It's all predicated on stocks and bonds. And so when you see, and this is nominal returns. So again, real returns, nominals, pre-taxes, inflation, all that other stuff. But you go back to 1871 and look at this. So you see, US stocks, so this would be positive, right? This would be negative. So you see that kind of negative almost 20 for US stocks. And then you have US bonds, which this is the zero return here. And then you have the positive return up and the negative return down. Pretty wild, right? You've never really seen an environment where they've kind of both, very technically have sucked together, right? They were horrible. So the average, default financial advisor portfolio is 60% stocks, 40% bonds. Well, this is one of those years where it really didn't matter what breakdown you had between the two. And we'll jump into, kind of stocks and bonds and some, just performance figures from indices and different things that we typically talk about later on. But yeah, this is an interesting chart. Any thoughts, Josh, on this one?
Yeah, I mean, I think it's just kind of like we've talked about before, where the 60-40 bond portfolio is sort of designed based on, the theory of modern portfolio theory, which is basically, saying that, hey, it's, easy to control risk versus reward in a portfolio, which may be the case in theory, but then, as we've talked about many times, it doesn't always hold up snuff when you put people in the mix and the real world in the mix. I think this year's been kind of a prime example where, ultimately when central banks start trying to get creative, there's going to be a whipsaw effect that's going to throw any, textbook theories about investing out the window. And, we sort of thought this would happen, and now we're seeing it firsthand. Well, this is exactly what happens. Like, you can't necessarily just pretty picture to control risk. There's a lot more that goes into it and a lot more types of risk, which I'm sure we'll get into this here in a little bit, but I mean, this is even like factor in inflation and taxes, like you mentioned. Like, this is it's already the worst before even taking out taxes and inflation. We add inflation, it's
nobody made any money, right? There's not going to be a whole lot of capital gains in 2022 where people are paying on stuff, or hopefully not, right? And
but you have one of the biggest cohorts of retirees retiring in history. Like, all the baby boomers are coming up to retirement. And so, it's with that comes 401k distributions. So even if you're not getting taxed on the investments themselves, you're getting taxed on that 401k distribution. Sure. So you're getting shitty returns and taxed out of the wazoo on the 401k, which is So yeah, like, and then you add the fact that we've had massive inflation too. These returns start to get really, really abysmal, even more so than, worst returns in almost recorded history, which is kind of nuts to begin with.
Yeah, and I think anyone that retired and was like, hey, I feel really good about, my safe money being in bonds, and I have a good amount of assets, and I've been told that I'm in a good spot. All of a sudden they see this year happen, and you're like, oh crap, like, is this going to be something that happens into the future? And then am I as, safe, and is this the right place for money in the future? And I don't think we've really seen people, what I would call, very technical term again, freak out yet. I think as statements roll out for the end of the year and people look at how much, 2020 and returns and all that stuff, like, they're going to start to ask more of those questions. And I would encourage, people to ask those questions to anyone that's helping them manage it, or if they're doing it themselves, what are they doing to, position themselves in the environment that we're in for the future? And so the next, I'm going to have a ton of tabs open for those that are watching. But again, Twitter, you got to look at this. I think this one is actually great. And so talking about inflation, there's lots of different definitions of inflation, because Josh, you and I, our spending habits are not the exact same. So when you are buying, item XYZ, I might not be interested in that, but let's say item XYZ went up and it was 20%, right? So yeah, right. Like, I'm not going to, acquire the same goods, but the thing that does actually impact us the exact same is the money supply. And there's lots of nuance that people can talk about when it comes to, the overseas or Eurodollar system with dollars. But you can look at the M2 money supply as a really good indication of inflation. Because at the end of the day, if you have, your income, whether it's your business owner, W2 wage earner, and you get your, cost of living adjustment or a raise or any of that stuff, does it keep up with inflation? So again, if you're buying a house, a lot harder this past, 12 months, 18 months, 24 months, 36 months, right? And we'll chat a little bit on housing. But something really interesting happened here, Josh, is the first time since 1952 that we didn't actually increase the money supply. And this was the reckoning of, hey, quantitative tightening, right? The Federal Reserve raised interest rates, and we'll have a chart in a little bit that shows this, the fastest that they've ever done it. And what they were trying to do is, limit the inflationary pressures out there. So put people out of business, get people unemployed so that they can, squash inflation. This should absolutely blow your mind looking at this chart. And I'm going to make it a little bit bigger to make it easier to see. Well, maybe not. Anyways, just the idea of how much, and you think about stimulus, and the one thing I'm going to talk about before I turn it over is just the idea that, 2008, the amount of money that was given for bailouts and for, these different programs coming out of 2008 was a lot. But then you look at what happened in COVID, and it was a lot plus a humongous amount, right? And so when this happens again, it's going to have to be bigger and bigger every time, because there's no way for a credit-based system like we have in the United States for it to get smaller and be sustainable. It has to continue to grow. And that's exactly what this chart shows. So any thoughts on this? Did this surprise you?
I mean, it doesn't surprise me, because we talk about this all the time. It's one of our main. But I mean, it is fascinating, and it's also fascinating to see how we're going to unwind it, if we're going to be able to, as history has taught. And anyone who hasn't read, this is one of my favorite books of recent history, is Ray Dalio's new book, Principles for a Changing World Order, which, he's basically runs the largest hedge fund in the world, and wrote a book about, 1,500 years of history and the rise and falls of empires and currencies and all that fun stuff. And, basically what he proved is the music doesn't last forever. And at some point there's going to be a reckoning. Some countries are very good throughout history at, pulling out of those reckonings. Like, China is an example where they've had, 5,000-year history. Whereas you look at the Dutch Empire, the British Empire, all collapsed, epically. And so it's gonna be interesting to see, is the quote unquote US empire going to be doing the exact same thing as the money supply becomes, too stretched to bear. And we've talked a lot about kind of, you were talking about the euro or petrodollar and things like that I would argue Russia's and China are currently trying to disable or disrupt, which that's one of the systems that keeps that growth sustainable. But I mean, even seeing that, I mean, granted, we went down in 2022, but Congress, and actually you may know better than I do, I can't remember if it officially passed yet or not, but the 1.9 trillion stimulus bill, did it officially pass this week?
It did. There was a video that was put out from the White House and again, Josh and I made this pretty clear that I'm just pretty disenfranchised from a political spectrum in general. But there was a video put out. It was, I don't know, 2 minutes, and it was a stack of like these big blue fancy, pad folio things of President Biden signing all this stuff that was in the bill, and it was just this huge stack. And then they did like a time lapse of him doing it, and it was like pushed out through social media. And I'm like, I don't know, is that a good thing? Like, should we be happy that it takes that long to sign something? I don't know if that's necessarily a positive. So it passed. So there's a lot of stuff going on, and we're going to continue to create more dollars and cents in the United States. And I think that's one of the interesting things, kind of going back to charts or just things that are out there. I think Luke Groman has had a really interesting opinion on things just in general. And so he's talked a lot about how the US, and this is a tweet that I'm showing for those that are listening, that cannot afford its debt, entitlements, and military spending without negative real United States Treasury bonds, which basically it would mean if you're buying a bond, you're signing up to absolutely get less money at the end of that. So if I buy a bond that's, let's say, 10 years from now, and I'm saying, you know what, I'm actually happy in the next, at the end of this in 10 years to have less money than what I have today in purchasing power. And most savvy investors should want to do that. And we'll get into a number of different things and some of the issues with that, because you can see right now, right, there are shorter yielding bonds. So like a 2-year bond is paying more than a 10-year bond, and that's called a yield curve inversion, which is a fancy term for, hey, people are owning these longer duration or longer time frame bonds because they don't actually believe that rates will stay this high. They think we'll go into some sort of recession or like this depression scenario where they're going to make money owning this debt because everything's going to get cut, and they're going to kind of swoop in and create more things. But you talked about it, like Russia and China have purchased more gold than any other sovereign nation around the world, right? They are trying to absolutely create something that is not dollar denominated. So right now the dollar drives the world. It's the engine that makes everything go. And so if that changes, obviously that's some serious headaches, right, for those in the United States, and that would impact every individual, right? Because we've had the privilege of having the global reserve currency, and that's been very, very beneficial to those in the United States for a long time. So, but with that, right, as we talked about, money going up and these different things. So the federal government right now, the interest expense on our debt is, this is Q3 2022, right? So it's a little delayed, but this is coming directly from the Federal Reserve. It's $737 billion, and for those that are listening, right, this is a chart that really started to take off, call it in the late 70s, and has really gone what I would call like parabolic. Like if I own this and this was a stock, I'm happy with the returns, right? Like it's up and to the right. And so just the interest expense on the debt that we have is going to be one of the biggest line items for the federal government. And how do you solve that? And I think that was one of the questions that you asked, Josh. I want to throw it back to you. How do you think that gets solved? Does the federal government all of a sudden find religion and decide to get responsible and say, you know what, we should probably just live within our means and cut back? Because that doesn't seem very electable. If I ran for president or for the Senate and said, you know what, I'm going to make your life suck more for 4 years, but we're going to make it better in the long run. Like, are you going to give me your vote, Josh?
Well, I would, but no. Most Americans are not.
One vote would be from Josh.
Yeah, no, like, and I think that's the problem. I think that's what's gotten us in this position in the first place. And I think that's what sort of Ray Dalio was arguing, in his book, was just that basically one of the downsides of democracy and kind of free economic systems that we have, they're designed and, structured around the vote and around popular demand and public opinion. And basically people get very comfortable lives, and they want the next generation to have an even more comfortable life. And the problem is that just can't live forever. Like, you lose productivity. I mean, I think we're seeing that now, where like you have like there's the memes all over the place of like, how like the Twitter employees like basically walk in and it's just showing like all the free food and not actually doing any work and stuff like that. Like, you compare that to like some of the factory workers from the 1900s and just compare like productivity levels. Granted, you can do a lot more technology and stuff, but I think every generation throughout history is, I forget the exact saying, but like, hard times make hard men, blah, blah, and, good times make soft men, and then soft men make, or good times then make hard times, etc. I can't remember the exact saying, but you get it. You get the gist.
Yeah.
But yeah, I mean, So I think the only way this ends is, either through a breaking or through some hard reset, which I know there's been, talk of hard resets, but whether any politicians will going to be willing to do it or not, like I think the only way they're going to be willing to do it is if, we're so desperate that they have to, like there's literally no other choice. I don't think any politician is going to willingly win an election based on, hey, I'd like to make your life harder. So it's not extremely hard 10 years from now.
Yep. And so, I mean, coming back to that, it's either, okay, we get responsible and we start having to cut entitlements or extra spending or, tighten the belt, or it is the idea that inflation is going to be higher. So the Federal Reserve historically has always said, hey, 2% is our target. You should always be asking, why does inflation need to happen for a good economy? The spoiler is it doesn't need to. It's a lie that's been told for a lot of years. But basically, they're now saying, well, maybe it's going to be 3 to 4% instead of 2. So you literally are going to double inflation, right? Like that's a doubling. And this is a stair step up. This doesn't come back down. And so like if that's what they're targeting for an average, that gets really tricky. But the reason that they would want to do that is this little, line here with Luke Groman again with a great tweet that was out right at the end of last year. So end of 2022. The US has never entered a recession with debt to GDP. So debt is what we owe versus GDP, what we make. Right now, it's 125%, which means we have more debt than we have creation in the economy. And so it'd be, like an example would be a family that, they're making X, but they're spending X plus Y. And then they're putting it on this credit card and this credit card and this credit card, and they're like rotating and playing that game. And so it's really interesting to think like, oh, well, it's always worked. It'll fix itself. It's really hard to do. And what he's talking about here is like, we've never seen, the United States move into a recession. And so some people will say, well, are we going to move into recession? And I talked about it a little bit earlier, this inverted yield curve thing. So James Lavish has a good tweet thread and has a really good article that we could share about inverted yield curves, fancy, jargon in financial circles of just basically saying, if you're borrowing money in a shorter duration, so I borrow money at 2 years, or money at 10 years. At 10 years, you should be getting paid more since you're giving your money to someone else. And right now, that is not the case. And so what's happened is right now we are at the highest negative difference between that 2 and 10 years since the 1980s. And you're like, okay, Isaiah, Josh, why does that matter? Well, the next piece is why it matters. So if you see this chart, again, this is kind of why you would want to see and tune in on YouTube. Basically, anytime there is a inverted yield curve, and I think it's 6 out of 8. So it's pretty good. It's not always right? It's not a golden signal every single time, but there's been recessions. And we've talked about on this podcast before, candidly, I think we've been in a recession for a little while, but 2023 will be interesting to see if it officially makes it there. And so what this is showing is like, hey, that inversion is a big signal to say, hey, we're going into a recession. Hey, we're going into a recession. Like, here's your sign. This is what you need to do. And so for a lot of people historically, so going back to why would someone want to own a 10-year bond if it's paying them less yield-wise than the 2-year, is because when you go into these recessions, the playbook has always been cut interest rates, stimulate the economy, cut interest rates, stimulate the economy. But to Luke's point, we've never had the environment that we're in right now with the amount of debt that is on both public and the federal government, the balance sheets. So it's really tricky. Like, will the playbook that we've used in the past work? Luke's saying it won't. There's lots of people that say, yeah, it's fine. It'll work. It'll happen just like it was before. And so a lot of investors, a lot of really savvy individuals are saying, hey, this is the playbook. When this happens, you see yield curve inversion. Go and buy the long duration, bond, because when we go into recession, that works really well. And that's how you see a good return, because you see this deflationary bust. So think COVID, think, great financial crisis, think, tech wreck in the early 2000s, think 1987, like all those kind of periods, long duration bonds do really, really well. So again, you can speculate, you can try to think through what it is, but that's why kind of the yield curve piece is important to understand, but also the amount of debt that the United States has is troubling. And it's the same around the world too.
Yeah. And I think it's even more troubling too, compared when we factor in that, clearly it's not urgent enough to make any differences where, even if we're seeing like the early warning signs to, major crises, like, the fact that Congress is still passing a $1.9 trillion bill is not good. Like, So, one, there's obviously, like you said, spells signs to recession and signs to issues in the bond market. Well, more money printing and things like that, like we just were talking about. Also, I mean, that's funded through government bonds, government treasuries, and things like that. So, I mean, you dump more of these into the markets, that also is not a good thing. So it's a compounding problem that, our government doesn't seem to be admitting. And I think with that, it's going to just continue to get worse and worse and worse and worse until something breaks.
And again, another point, and this is from yesterday, the Fed funds rate a year ago, so January 1st, 2022, was 8 basis points or 0.08. Josh, you know what it is today? Any guesses?
I think it's like 4.5. Right?
It's 4.33, so 4 1/3.
That's close.
Insane, the rate of change. And so what does that do?
Actually, well, it's the fastest increase in history.
Yeah. And so what does that do is you have a lot of US corporations are considered high yield, which is a fancy term for they borrow at the worst rates. It's called junk debt. And you have a lot of these borrowers that are going to have to refinance, and they were able to refinance in 2021 somewhere in the 5% range. Right now, when that bond, when they have to go out and get more money to fund their operations, it's no longer at 5. Now it's closer to 9. So again, the same way that it's an issue on the US government side, right? So we take all this debt that we have and you move from really low rate to, closer to 4% or 3.5. Hey, all of a sudden the interest expense gets bigger. Same thing for businesses. And so if you're a business and let's say your profit margin is 10%, 15%, 5%. So the average of a small business in the United States is 10. You double what your interest is on what you're paying on your debt. How is that helping that business, and what happens to a lot of those businesses? The answer is they don't exist very long. Like they file for bankruptcy. They aren't going to be able to finance themselves. And so in a world of really cheap debt, it's been easy to kind of kick the can down the road, and extend that debt. All of a sudden that changes, and it's like, something happened. And so Joe Consorti, I think is how you say it, had a really good tweet and kind of showing that. And then Greg Foss, another good one, is just the amount of distressed debt globally. And you can see one of the places that a lot of distressed debt, so it just basically means debt that's, it's in real estate. And so that's an interesting area to think about, where so much borrowing happens in commercial real estate and commercial properties. And one of the areas that, I don't have a chart for it, but one area that you can see that has never recovered from pre-COVID. So, right, most things are up since the depths of the COVID crash, right, is REITs, so real estate investment trusts that are kind of office space. So those office space REITs are still underwater from the beginning of 2020. They never recovered. A lot of the other things have gone up. Now that maybe they've come back a little bit in 2022, but office REITs never recovered. And so there's a lot of debt for a lot of those big properties in major metropolitan areas that the work from home crowd is like, I don't want to go back to work. But then you're seeing different companies that are saying, hey, you need to come back. So it's interesting. So when you think about rising interest rates, think, how are companies able to finance themselves, and will they be viable in the future? And so this idea of the Fed funds rate, which kind of sets where people can borrow at for a lot of, both public and private debt, massive rate of change. And to Josh's point, wild.
Also, we haven't really talked about this in terms of the Fed fund rates, but this has a direct, or I guess more indirect, implication on consumer debt, like credit cards, mortgages, obviously, and things like that too, which, like, mortgage costs, we don't have a chart for this, but mortgage costs went up about 110% plus in 2022. Credit card rates we've seen skyrocketing. Like, quick anecdote, in our financial planning software, like, we actually hit an issue where we had credit card interest rates that we needed to enter that literally our financial planning software couldn't take because it was too high, because it hadn't been that high, period. Yeah. So, and we're also seeing consumer debt, especially credit card debt, skyrocketing through 2022. So it's not just debt on the government side of things, it's debt just everywhere. To your point, like, it's in real estate, it's in businesses, it's in individuals and households. Like, so the rise in interest rates has a pretty far-reaching implication on everyone in one way, shape, or form. That's part of why, what makes us nervous is that it has such a far-reaching implication, because it can make, business in your retirement fund go out of business at the same time while your credit cards and stuff are going up and mortgages are going up and all these different things. So it's pretty damning across the board, which is why we talk about it a lot.
So what's done well in 2022 is kind of, and we'll have a full like little chart that we'll show you, but it is hard assets, right? So things that are tied to inflation. And so one of the interesting things, and this is from December, so there's a sovereign wealth fund in Australia, and basically they increase their exposure to things that I would call real assets or hard assets, so gold, commodities, and infrastructure. And so again, this is a tweet from Luke Roman, but it's the idea that this will echo the low growth, high inflation era of the 1970s. And really interesting to see that, what they're talking about in their note is, hey, the 60-40 portfolio is not giving us the returns that we have been expecting. And we need to make sure that we're deriving returns for sovereign wealth funds. So we're going to go and start to allocate to other things. And so, like I said before, as a individual, if you do it yourself, you work with an advisor, whatever, you start to see a year with no returns or negative returns, another year with muted returns. It's going to be pretty soon that you're going to be like, WTF, what's going on? Like, where can we make some money? Where can I at least see the amount of money that I'm saving into this? If I'm saving into it over time, like it's not going up and I'm putting extra money, just keeps going down. People are going to get disenfranchised with the way things are. And all of a sudden that, hey, I just save into the S&P 500 and make 12 to 14%. It's easy. That goes away. And I think that is one that's interesting to where, we might see other, larger investment portfolios start to own these type of things, but commodities have been, absolutely abysmal return-wise for a decade. Haven't made any money. And last year it was a year that commodities did really, really well. So, starting to see some of the funds flow that way will be interesting and something definitely to track in 2023. This is another chart that I'm going to explain visually. So Dylan LeClaire had posted basically there's this gold, you see gold price per ounce, and then you can see the 10-year real yield or 10-year interest rates on bonds, but it's the inverse. And you can see for those that are watching, hey, this has been really tightly correlated, right? It kind of overlays each other, the black line, the blue line, and he's saying, who's wrong? And so you have folks that own gold saying, hey, inflation is going to stick around. And you have people that are making bets on owning bonds, especially low yielding, longer duration bonds, saying, you know what, we think we're going to go into a deflation, a recession, this economic, slowdown. That's what we're positioned for. And so there's like this disconnect. And I've seen it for a lot of what I would call thinkers in just kind of the macro or big picture space, saying there's things that are saying this is what's going to happen. We're going to see higher inflation, and we're going to see kind of a replay of 2022 into the next year and into the next, several. But then there's also this, hey, there's these inverted yield curves. There's, this notion of a slowdown. We're going to see this deflationary bust. And those two things don't always align because you want to own a couple different assets depending on what's going on, because bonds had, again, their worst year on record for quite a while last year. But I think this is a really interesting thing to think about, of this inflation versus deflation push and pull from that standpoint. Any thoughts on the allocation to gold? I know we're not, gold bugs and, bearing bars of gold in our backyard, but it is an interesting, asset that is typically the idea of, you're trying to stay wealthy, not necessarily get wealthy with it.
Yeah, I mean, I think, kind of like you said, I think we're not gold bugs for gold is everything, but I mean, at the same time, just kind of the way we think about anything, I think it can have a place in a portfolio depending on what risk it's protecting against. And I think right now is one of those time frames where, yeah, I mean, I think gold makes a lot of sense. And I think, pretty much every country outside of the US sort of seems to see that. Whereas like, Russia, China, and a lot of countries have been just hoarding gold over the past, 5-10 years. So I mean, I think there's a huge case for that, globally right now. But I mean, I think, there's an interesting question here, kind of for you and I of, who do we see being right over the next 5-10 years? Do we see inflation subsiding and, the 10-year treasury being the right play, or do we see gold? Obviously, this is not an investment recommendation by any means, but I'd love to hear your thoughts on that.
Yeah. So, I mean, if you had to push one thing or the other, are we going to see deflation or inflation? I think you're going to see a little bit of both. So I think it's all about timing, right? I think you'll see deflation initially, but the inflationary pressures, and again, what are we defining inflation? It is the increase of the money supply. Inflation will happen, cannot be stopped. It is mathematically certain. I feel very confident saying you see inflation over the years. Now, does 2023 bring a deflationary shock to where you see that slowdown? Yeah, I think that makes a ton of sense, and you're seeing a lot of those signs. But I think longer term, the federal government comes in, the Federal Reserve says, hey, we're going to cut interest rates, we're going to come in and save and revive the patient, right? Because they're struggling to breathe. We need to get them some oxygen. How do they do that? They're going to pump the system full of money. And the only thing that gives me pause of saying, hey, I think it's inflation longer is this. And so a lot of people, you might have noticed at the gas pump, it's less. Now, unless you drive a diesel truck, so sorry about those folks, or you got your TDI Jetta, which I used to have one. It's an awesome car, great for college when I commuted. So diesel hasn't really come down in price. And so there's some issues there. But basically, again, shout out to Joe Connoissorti. And for those listening, it's basically the US Strategic Petroleum Reserve is now down to 19 days worth of supply. So what we've done in our very wise thinking from a strategic point of view is, hey, we're not in a war, but you know what? We want to make sure that we can keep gas prices low for people. So what we're going to do is
get them votes.
Yeah, we gotta keep our inventory levels that are supposed to be there for the worst case scenario, right? These are strategic reserves. We've drained those to help keep prices lower. Now, am I happy when I go and fill up that it's, in Indiana, I think it's just under $3 the other day? That's awesome. I'm glad it's not $5.25 anymore. But what I would encourage you to think about is it's going to go back to $5.25 because we can't suppress that for that much longer. And guess what? The world is still short energy. And so that is inflationary. And so again, for me, it's like there are big forces that are telling you that either thing will happen. And the worst case scenario is inflation is sticky and high, and you see the economy go into this spiral. And that's that kind of stagflation environment that Luke, I think, talked about, late 70s, early 80s. That was just a sucky time to be doing anything. If you're a business owner, it's hard because your costs are going up and you can't charge more because no one can afford your services, because they're not getting a raise. And it's tricky and it's hard. So I think that's what makes 2023 fascinating. Maybe not fun, but fascinating.
Yeah, I mean, I would agree. And I mean, I think aside from gas, which is obviously, gas kind of goes into everything when it comes to inflation, more than just the direct costs of, us filling up. When you go to Target and things cost more, it's also because their transportation costs and deliveries and all those things cost more. Oil goes into plastics. If oil costs more, plastics cost more, so on and so forth. So, I mean, you'll start seeing the cost of things rise sort of across the board with oil going up. And yeah, I mean, it's one of those scenarios where we didn't see probably as much inflation as we probably should have, because a lot of companies were suppressing the transportation costs and stuff just to make their earnings and stuff look better, because they didn't want to crush people, with higher prices right ahead of holiday seasons and things like that. So, I mean, I think we are going to see some, companies like Target and Walmart and Amazon starting passing some of those costs through to consumers. And
they have to.
Yeah, they have to. And you're going to see that come through in inflationary measures. And I think too, I don't think we've actually seen the impacts of the droughts in China, the war in Ukraine, and things like that on the food prices. I think those have been relatively stable compared to where they should be, which is hard to, seems weird to say, because that's probably where, outside of oil, where a lot of the inflation has been in food prices. But
energy and food are the two things that impact every single person, right? Energy and food impacts every single person.
And I don't think we've seen the full impact of that yet. I'd be wrong there. I don't have any data on that, but just.
So are you in the inflation camp? So I feel like you're tilting more towards the inflation camp than the deflation camp.
Yeah, I mean, I just don't see any way deflation is going to happen. Seems to me there's too many forces pushing inflation higher. I just really do.
And so it's a Greg Foss tweet, but it's from Bill Ackman, who's I would call him a legendary investor. I don't really care much for Bill Ackman, but this is an interesting piece because he is very much traditional finance from that standpoint. But he says, for those that are listening, I don't think the Fed can get inflation back to 2% without a deep recession. Even if it gets back to 2%, it won't remain stable there for long. Accepting 3+% inflation is better strategy for a long-term economy and job growth. So what he's saying again is that inflation will be higher for longer. And that is what I think the narrative is out there is, hey, we're going to bring inflation down. So it's not going to be 7 or 8 on the CPI, but it's going to be 4 or 5. And that's just going to be consistent. And so again, if you think about 4 or 5% in increasing prices year over year over year. Like you start fast forwarding that out over 5-10 years, that is a massive, massive change. And I actually really love this quote. I didn't even see it till just now. I don't know who Sean is down here, but his quote is from Milton Friedman. He goes, if you put the federal government in charge of the Sahara Desert in 5 years, there'd be a shortage of sand. Like, that is hilarious. So I've never heard that, but I love that quote. I may use that again in the future. Last one on kind of the gold perspective and CPI just in general. And again, charts can deceive a little bit, but this is one you can run it back farther and it still looks like a mountain like this. So again, Joe kind of sorty, good follow on Twitter. If you can't tell, I like, Joe, and he actually is in the camp of probably deflation sooner than later. So, but he talked about the detachment of money from physical reality as a consequence that's been disaster for the human race. And it's the CPI index. And you can see, hey, we deep peg from gold and all of a sudden, the dollar's backed by nothing. And you see inflation rear its head much more, right? Because there is no regulator on the amount of money that can be created because there's no one that has to ask. Inflation is this insidious tax that, no one has to pass legislation for, right? It just happens. And so I think that's one that is hard for people to get their mind around, but it's like once you see it and once it lands, it's like, oh shoot, that sucks. I don't like that, but there's really nothing you can do. And it's not a red or blue type of thing because, right, there's been lots of Republicans, lots of Democrats in this period. It doesn't matter. Does not matter who it is. It's been the same story from that standpoint. Any thoughts on that and CPI and just the growth of it over time?
Yeah, I mean, but I think it just harkens back to everything we've been talking about, where it's just, we as a society have tried to keep music running and amplify the music more so than, should naturally occur, just because, humans are greedy individuals or greedy species by nature. And I think this is the CPI, is just a clear indication of us just doing what we're naturally compelled to do is, hey, we're gonna grow despite future impacts. I think this is a clear visual that's the case. Actually, circling back real quick, one thing I wanted to ask you along the lines of inflation versus deflation. So I was actually looking for the chart a minute ago, but I'd seen a chart that basically said throughout history, there's never been a time where inflation has subsided unless interest rates have gone higher than the inflation rate.
Yep, and that is from not Tudor Jones. That is it's one of the other big famous kind of hedge fund guys. He talked about that. Druckenmiller, Stanley Druckenmiller talked about that, and I've seen that. You're exactly right, where they've never been able to tame inflation. And so going back to Paul Volcker back into the 80s, jacked up rates really fast and was able to get it over and above inflation. But that's when rates were, double digits or really high single digits. We're at, 4.5 right now, and things are starting to crack. There's no way in hell, not a snowball's chance in hell, that we get anywhere close to those numbers without everything just imploding. And that's kind of what the Ackman quote was, right? So coming back to what Foss was saying, right, on his tweet, which was just oh nope, that's the wrong one. Where's my Foss tweet? That is exactly what he was talking about. So let me see if I can.
That's kind of what made me think of it was.
Yeah, and it's spot on. And so it's going to be like they're trying to lay, and I say they. So let me define they, because anytime people say they, you have to ask who is they. So I think the powers that be in the federal government, Federal Reserve, like they need to normalize higher inflation because it's been so long that it's 2% is our goal, 2% is our goal, 2% is our goal. They have to get people comfortable with it being much higher than that, because if they try to get it back to 2, I agree with Bill. Deep recession, like you're talking massive unemployment. This is no good because they can pump as much money as they want back in, but everything's going to be dead. It's like you take Roundup and you spray your whole front lawn, and then you're like, oh, I'm going to go water it. Doesn't work. Like that's what it would do if they tried to raise rates to 10%. Like it is, it's torched. Like there's no way it comes back in any fashion for a long time, and that would be a horrible place to be for a while. Like that would be Mad Max, The Purge type situation. Like, and no one wants that. So,
so I guess my follow-up question to this is then, so if you tend to be in the potentially the deflation camp, what do you think is going to be the impact to pull inflation back? Is it the deep recession itself or what?
Yeah. So because we are, and I think it's the privilege of having the dollar be the global reserve currency, there's still so much demand internationally for our debt because our rates have gone up. So we haven't necessarily gone into it. I don't know if we will. So like Japan has had a lot of issues because they tried to peg their government debt and rates at like 0.25%, and they just raised it to 0.5%. But they own pretty much all their debt. And so if I am a international sovereign wealth fund and I need a bond allocation, am I going to go to Japan and get 0.5%? Am I going to go to the US and get 4%? So there is still structural demand for the United States in debt. And so I think there still is a buyer of that debt over time. And it's hard for me to make the case because I do think like the inflation runs away. And like, again, anyone that's listening to this, like this is the whole idea of, and Foss has it here. It's a debt spiral. It's just math. And this all leads to Bitcoin, but I'm not going like that is years to play out. That's not, I think, in a 2023 or 2024 type situation where you could still see deflation because you see big layoffs because companies can't survive. And going back to just the financing, if you roll over financing, you can't, fund your business, you're looking to get acquired or you're going out of business. And so that is going to be, deflationary from that standpoint, but it's a temporary deflation because of the Federal Reserve being so aggressive in raising rates. That's the only reason. But what they're going to do is cut rates again and inject more money, bigger than COVID, bigger than the great financial crisis. And what does that do? That's inflationary again. And so it just starts the cycle again. But I think the bigger question is, when does that cycle break and when can they not do it anymore? When can they not revive the patient? And I don't know that answer. That is the trillion dollar question. If I knew that answer, Josh, we wouldn't be having a podcast, right? we would have we'd have our macro hedge fund and we would have our yacht.
Yeah, we'd be diving into our pool of gold coins right now.
But I mean, that's the thing to think about is I don't think there's enough people that see it going off the rails as bad as it could go. And so this next turn will be similar to what it's been in the past. So you'll get deflation followed by, higher inflation behind it. But again, it's hard for me to make the deflation argument, but I've heard a couple of compelling cases recently because I've sought them out because I don't think that's the base case, but I'm like, man, those are actually really compelling. So it's tricky. But I do think this is an interesting take from Ackman that they have to normalize a higher inflation. So I just don't think inflation comes down really much, but this is funny. So the Dallas Fed puts out a survey and whoever replies to it. So the Dallas Fed, a lot of it I think is like business owners, CEOs, executives and stuff. So this to me is a very interesting quote from an unknown source, but never doubt the ability of the Federal Reserve to crush the economy when they intervene to stop inflation. And so to me, that again is one of those things where if you're mandated to stop inflation, you have a hammer, everything looks like a nail and you're just pounding the crap out of everything until it doesn't move. And that's the result. I think this is a really good kind of closing piece from James Lavish on macro in general. And Mark Andreessen had a little tweet about no one has any idea what happens with stock prices, inflation, interest rates, or the economy in 2023. James goes, it's a game of probabilities. He goes, and this is James saying, right? He, similar to kind of the way that you look at it, Josh, high probability of inflation sticking, the Fed erring on over tightening for too long, so raising interest rates too high, leading the cost of capital to negatively impact the economy. So businesses can't finance themselves and risk assets and stocks suffer until the Fed pivots again. So I think it's all a timing thing. And so that I would agree with James, that's going to be the thing. And that's going to then be, it's like it's two sides of the same coin. And I think that's the hard part to see it. And it's all a timing thing. But if you keep raising interest rates, you are going to crush the economy and you're going to kill a lot of businesses. Maybe not the Walmarts of the world, like they'll survive, right? They have the ability to borrow at really low rates. I'm talking about the economy, which is a lot of small businesses. And that puts a lot of people out of business, and that's a lot of jobs. So like those are the businesses that are going to get crushed ultimately. So anyways, thoughts on this? Again, I think James is a really good thinker. He's an ex-hedge fund guy, so he's pretty smart.
Yeah, I mean, I would agree. I mean, I think it's just going to be interesting to see.
It's fascinating.
Who pivots, when, where, why, and how, and what are the forces behind why they pivot? I mean, because right now it seems, we're on a train, bullet train to recession with, kind of nobody looking to sort of hit the brakes at all. But, I think they're going to have to at some point. Like you said, we're already starting to see the cracks. Eventually things are going to snap,
We're addicted to low interest rates for financing a lot of stuff, and that'll be a hard lesson to learn. So let's look at, we talk about ingredients a lot in investing. And so obviously here's a very fancy chart that Isaiah made in Excel, right? So the different ingredients and stuff that we track, I thought this was really interesting. So this is all 2022, year in numbers. So from January through the end of the year, just different information. So you see a lot of red, which is not a surprise to many people. But is there anything, Josh, that sticks out to you when you look at this or think about it?
I mean, the one that always sticks out to me is I think this should come as no surprise to you, but seeing bonds is some of the worst performing asset classes, and second only behind or above Bitcoin, which like Bitcoin, is the notorious like, oh, your cryptocurrency, you're the most volatile asset ever, and then there's right above it bonds, which are supposed to be the safest assets, bar none. And like that's what, hey, if you're 72 years old, you should have 70% of your assets in these things. Whereas if I said, hey, have 70% of your assets as a retiree in Bitcoin, everyone would be like, gasping at me. But
yeah, you're going to jail, Josh.
yeah, I would for sure lose my license. But yeah, to me, like that's the piece that's fascinating. Where like, as you and I will know, like bonds are just basically math that are like inverse of what happens with interest rates. So if interest rates go up, the seesaw goes down on the other side with bonds. But this is like the worst performance in history for bonds, which I mean, is fascinating in and of itself. But to think that a safe asset has now become a volatile asset is, again, just mind blowing to me.
Yep, worst year in history for global bonds. Yeah, not good.
Yeah,
not good at all.
And I mean, you can see the impacts of that in the 60-40 portfolio. But there should be in no world should there be a situation where the S&P 500 outperforms the bond market. Like that just like bonds are supposed to be your risk-free asset or as close to your risk-free asset as possible. Whereas like you have the S&P 500 doing better. Like it just doesn't make sense.
And it hasn't happened since the 1960s. And I have the chart somewhere. I'd have to dig through a couple, things. It was earlier in the year, so it wasn't year-end numbers, but it still holds true where anytime that the S&P 500 has been down 20% or more, so bear market, which the S&P at its worst point this year was about 25, long duration treasury bonds have always been the ballast, the thing that saves its kind of tail. And this was the first year it had been down more than the S&P. So that's since the 1960s, that's happened quite a bit. And so I think the big question, because there's a lot of money. So a lot of people, everyone's focused so much on the stock market, right? Bond market, way bigger, way bigger, way more assets in the bond market than in the stock market. And so when you talk about bonds, that is what, really drives a lot of, bigger pools of capital is fixed income or bonds. And so, yeah, to see them struggle as much as they have is interesting. The other thing that stood out to me, and we talked about it, we had Jack on the podcast from Alpha Architect, momentum, right? So you talk about momentum, and if you haven't listened to that episode, you should go listen to it. It's fantastic. But you look at U.S. momentum, so owning U.S. stocks with a momentum tilt, down 7%, the S&P down 18. It did really well. And you think momentum is not growth, right? And I think Jack really helps drive that point home. But the idea of factors or characteristics of owning stocks that tilt towards momentum and value worked really well. So U.S. momentum down 7, U.S. value down 11. Now, no one's happy when they lose money, but those are significantly better than the S&P. And the other thing that's interesting is EFA, which is just kind of international stocks. You see it work the same way, almost, right? So international value did much better. International momentum did slightly worse. But if you were to say, hey, I want to own momentum and value in the US and internationally, 3 out of those 4 did better than kind of their benchmarks. That's not every year, but it is something to take note of kind of, again, a rationale for why you want to own it. And we've talked before why the market cap weighting of the S&P 500, how it's constructed, doesn't make a lot of sense. It's kind of just, hey, you're a big company, you're worth a lot of money, you get in the index, you get a higher weighting. And so the US S&P 500 is basically all tech stocks at the moment. It's 25, 27%. And that's been the thing that's kind of struggled because a lot of tech companies don't make a lot of money and they finance with cheap debt for growth. And all of a sudden that changed in 2022. And so that's been one of the things that you saw start to shift. And so I know in the momentum and value indexes, a lot of it's been energy. And energy had a really good year in 2022. The other thing that's interesting is commodities. Again, we talked about it before. They were really struggling in the previous decade. They did fantastic in 2021 and even better in 2022. Long volatility. This is one that is a really interesting asset class. Not a lot of exposure for most people, not a lot of exposure even for clients of ours, but there are ways to allocate there. There's a really good firm that has some good research on long volatility called Artemis. You can read Chris Cole. He puts out lots of good content. And then CTAs or managed futures. This is just the index. So a blend of, I think, 50 different managers. There's a manager that we follow. I just wanted to show that because you basically have 7.5%, which is still awesome if you think about your alternative of being down 16. But the dispersion of, managers was somewhere between, a little bit positive to, obviously significant from that standpoint. And with managed futures, you're owning stocks, bonds, currencies, and commodities long and short. So fixed income or bonds do bad, you make money on that. Energy is going up, you make money on that. There's lots of ways with those pairs to do really well. And then also with currencies, the dollar was, I didn't put it on here, but the dollar was really, really strong in 2022. So any other thoughts on this? Anything that surprising or any other comments?
No, I think I think you had the main points from my side.
Let me see I think there was one other thing on the bond side that I wanted to bring up. Let me see on this. Yeah, this is interesting to think about. So again, people are gonna be like, hey, a lot of similar names and similar things. So the rising yields of the US Treasury will weaken the US economy. And you're starting to see gold when measured against bonds. So again, if you go back to the earlier chart with Dylan, where it had the breakdown of gold going up, bonds going down. Big question is what's going to give? Are bonds going to all of a sudden say, hey, we're going to perform much better? They're not going to hike interest rates anymore. We see this deflationary event, they cut interest rates, and we're off to the races. A large unnamed CIO of a large RIA that I see things very differently was telling people in April, you need to be a patient bond investor. And you got smacked in the face for the rest of the year from that standpoint. And the question is going to be, are people going to be patient bond investors in 2023 if they continue to see losses? Because when you own bonds, it's not really the get rich portion of your allocation. It's supposed to be the stay wealthy and get a little yield. And then all of a sudden, when you're supposed to be getting maybe 3-4% on that, maybe a little appreciation, and you're losing 20, that's a lot of years of income that all of a sudden evaporated. And if you're starting to draw on that money as a retiree or someone that needs those funds, look out, right? Like that gets nasty pretty quickly. And so it's going to be interesting if people start to head for the exits and sell bonds and move into something else. Will that be something like a gold? Will it be something like commodities if inflation's higher? And that is, again, back to the questions that are out there. But any thoughts on that?
Nothing that popped into my. I had a thought, but I lost it, to be honest.
All good. Something that I followed in the Bitcoin space that gets brought up a lot is, well, Bitcoin's never had 2 years that are down in a row. Interesting enough, same is true for stocks since 2000 and 2002. It's never had back-to-back years of being down. And I didn't think about that or even realize that before this tweet was posted. And you can see it's like, hey, 2008, this is probably 11, 18, and then 2018 would probably be there. Anyways, and then you see 2022. I'm not going to try to remember each and every single one of these, but you haven't seen back-to-back negative years on the S&P 500 since 2000 to 2002. And so if you remember, for those that are, students of market history, from 2000 to 2009 was a lost decade. The S&P 500 annualized a little over -1%. So it was definitely a spot to not be, and it was rough for people to just sit through that. And so the question is, if you're going to own equities, you're going to own them for 10 years or more. And I think for a lot of people, the answer is no, but they don't know that yet. Yeah. So this is a really good chart. I'm just showing like, okay, the S&P 500 was down. What was the only thing that did well? Energy. It was up 60%, right? But the funny thing is energy is only 6% of the index, Josh, because they've kicked everyone out because they stunk for so many years. And they got replaced by information technology.
Shocker.
So that is an interesting thing to keep tabs on.
Yeah, I hadn't seen this chart before. That's pretty hilarious, not gonna lie.
I'm gonna keep going.
But this is one of those years where we talk about a lot about boring is beautiful, where you have energy, utilities, consumer staples, so like deodorant and toothpaste, healthcare, things like that, where you get down to the sexy, infotech, comms, etc. Those have been the worst performing ones. So I think that's part of why we like boring is beautiful type businesses, is because, hey, they actually do well and still grow, in good times, but also do pretty well when they need to be defensive, which I think this is a clear indication of that.
Yep. And there's a little comment over here that Exxon was ripping. I don't know who this person is over here, but yeah, Exxon got kicked out of the SP 500, replaced by Salesforce. Salesforce went down 55%. Exxon was up 92. Huge dispersion between those. So again, the S&P 500 has some interesting rebalancing rules that don't always make sense. This is really interesting. So Jim Bianco from Bianco Research, last 15 years, really only the US stock market has not made anybody money. And so we're spoiled again in the United States where we think US, hey, stock market makes money. It always makes money. Like, yeah, sure, there's great financial crisis. There's these periods where it stinks, but it's like, oh no, like if you owned outside the US and owned zero in the US, you haven't made any money. And so the question is, and again, Jim kind of throws this out there, it's been 15 years of quantitative easing up until 2022. And all of a sudden, everyone's always been, hey, well, the Fed's going to pivot, the Fed's going to, change and make the market good again. And there's so much money that is in accounts of baby boomers, like they have to keep the stock market elevated because, you can make the claim it is one of those things that is a, national security risk, right? If we have people that can't afford to retire, that's a bad thing, right? Inflation has ended the era of cheap money. We've talked about that. And all of a sudden we're wanting the bull case. I love this, right? For Jim, because the bull case is helicopter money returning, not valuation, because stocks still aren't cheap. Valuations aren't there because a lot of these companies aren't going to be making more money in 2023. Like things are getting worse, right? Expenses are going up and they aren't able to definitely raise prices, or if they do, they're going to start to see the impact of that. So I think Jim's spot on with that. And
well, that actually brings up a really good point, because I've seen a lot of comments and stuff lately about like, oh, buy the dip, like now's a perfect time to buy in, buy the SP 500, etc. I think people just don't realize that, like, yeah, helicopter money may come back in, but it's a more and more unstable house of cards. If it does come back in, it's like, would you want your money all in that one bet? Yeah, probably not. It's just
yeah, and you can wait
there.
And you can wait until you start to see the helicopter money coming back in and you see the programs being initiated. And sure, you're not going to pick the bottom, but you're also not going to eat get punched in the face with things going down. So this is, again, friend and also guest of the podcast, Meb Faber, fantastic Twitter follow. I actually think he followed me after the podcast, which was cool. So that was great.
Man,
yeah. So he'll ask questions that are like, well, duh, right? But it's interesting. How do you invest? I'm boring and invest in the SP 500. And I love this, right? It is stocks actively selected by a committee, huge home country bias, no real assets, no bonds, no tethered evaluation, no trend. Boring is not the word I would use. I love that. That is a perfect definition of the issues with the S&P 500. The S&P 500 is not the end all be all, even though that's what everyone compares returns to. And there are years when you look like a genius, and there are years that you look like maybe like you did in 2022, where it's like, man, this doesn't work anymore. Like, what happened? But yeah, I might have to steal this. This is a really good little question and response there.
Yeah, and that's what we hear it all the time. We're just like, oh, just hold the SP 500. But I mean, like we're talking about, like, yeah, that's been a really good investment for the past 15 years. But from 2000 to 2010, there was that lost decade, and we're already seeing the worst foreign bond market in history. So just something that's gone up because it always goes up isn't necessarily an investment idea, right? Because history will prove you wrong eventually, because nothing lasts forever. I think we're sort of on the precipice where there's going to be, we have the tail end of all this quantitative easing, tail end of like the what I would call like the index or low cost index fund bubble. We're going to have a lot of people that are going to be caught with their pants down with their only investment strategies. Hey, I'm going to buy low cost ETFs. Yeah, I mean, I think those are a good thing, but you don't want that to be your only strategy. You need some sort of risk management, some sort of tie to value, tie to home, diversification across asset classes, home base, you name it, currencies, etc.
Yeah, it's the idea of actually trying to understand what you own. And I think a lot of people are naive and they have no idea of how much risk they take in the investments that they have. And they might say, hey, I'm conservative. And it's like, well, you're conservative, but you have 90% of your allocation to US equities. That's not conservative at all, right? Like that's not conservative. And I think a lot of people will, find that out. But yeah, you don't have to always be, 100% right. Part of it is just staying in the game and making sure that come hell or high water, you're able to compound. And so I think it's trying to find, again, the example I was using, ingredients, use the ingredients that are there. Some things are great standalone. Some things they need to be mixed in with other things, or they feel like it's disgusting or terrible. So how do you find the things that you can mix in to help, at the end of the day, make that max pain threshold, higher, so you don't have to take as much, that pain, but still get the returns that you need to ultimately hit, the goals that you want. I think that's what we always try to do, is like, hey, you should invest tied to when you need the money, what's the plan in place, all these other things, right? We can talk about all the macro and interesting things all day, but it's not always going to be everyone needs the S&P 500 because stocks always go up and that's what you need to hit your plan. Sometimes it's taking way too much risk and you don't need to do that. So, and risk come in all shapes and sizes, right? The risk of failing fast, failing slow, the risk of deflation, inflation. Remove those risks and your returns will improve and be more stable when you start looking at rolling returns over 3, 5, 10-year periods. So we'll talk about housing, and then we'll got to close on a little bit of Bitcoin. I only have 2 things on Bitcoin. Shocker. But housing, we'll chat a little bit on housing. How do you feel on housing, by the way, right now?
Well, I mean, I think we're starting to see the tip of the iceberg for things I've been calling for, about the past year, 2 years, maybe even 5 years, but kind of along the lines of like, after living in San Francisco, I heard San Francisco real estate always goes up, verbiage one too many times, where I'm like, if the herd's going one way, time to go the other. And also nothing lasts forever, kind of like I just mentioned. Well, the more I dove into real estate and realized like, dude, the valuations there are just insane. In a lot of areas are getting even more insane. Like at the peak, we had seen, valuations, cost to purchase, rents, everything, even more ridiculous than 2008. Like it's hard for people to grasp that, but like real estate was actually worse this past year than it was ahead of the real estate financial crisis, from a valuation perspective, which sort of blows people's minds, but it was. And so, that already caused one major recession. it's pretty obvious, like the writings on the wall with real estate. And we're starting to see, throughout 2022, we had some of the I actually saw you just pulled that up, the fastest housing slowdown on record. Like we had the fastest valuation drops in certain areas. Like I think like, was it June or July was the worst 2-month drop in history. And I think this is just getting started. To be honest, like, I think in real estate, next year or two is going to be a brutal year for corporate real estate, for single family homes. Because I mean, if we're going into recession, let's just take the inflation piece and the recession piece. Well, cost of housing went up 110% plus, and that was as of interest rates, I think I was right like 3.6 when I saw that. So it's probably gone up, who knows, 150%. Like when you factor in the full cost of a mortgage, not just the cost of the house, like what your monthly costs are. So you have that, and then you throw in a recession where people's are getting laid off, their stocks are going down in value, their 401ks are going down in value. You have baby boomers that are retiring, whose their 401ks are getting killed, but they have a bunch of equity in their house, that are going to start realizing, oh shit, maybe I should go get this apartment instead of just sitting on this $500,000 worth of equity. And so you're going to start seeing these sort of factors really start to snowball and impact real estate. And I think we're already starting to see that just from number of pending sales, number of actual sales, price drops in real estate. Like I think I forget the exact statistic you have it, Isaiah, but it was like
38% home sale index year-over-year drop right now.
Yeah,
So,
well, I was gonna say like too, like the ones that are listed, it was like something like 70.
Oh, Redfin has theirs that they've seen the most price cuts, but they've only tracked it back to like 2015, so it didn't show.
Yeah,
because they weren't around kind of in the previous big real estate downturn. But yeah, I mean, since they've been tracking it, it's the worst that it's ever been. But that's not really surprising because since 2015, it's kind of been a one-way ticket. So that and I think Odell talks about it here. This time is different. Like that's the 4 words that you're not supposed to utter in any investing rhetoric, that this time is different. It's like kind of is though, right? So again, housing slowdown, fastest on record during a Fed hiking cycle. So again, if you're raising interest rates, your payment goes higher, as you talked about. The asset price itself has to correct to be affordable, or no one is buying it. It locks up. And so what you're seeing right now is it's locked up. So either things need to go down in price, or we got to see interest rates come down, or we got to see both, right? Like something has to happen because no one is going to be able to afford them. the math doesn't work. And so again, it goes back to that whole situation.
Yeah, and I think we sort of established that interest rates probably aren't going down. It's, at least in the foreseeable future.
Yeah, they're gonna need to be somewhere. They're gonna have to stay likely less than inflation so that they're able to kind of inflate the debt away to keep that debt to GDP number hopefully starting to tilt lower so it doesn't accelerate, because if it accelerates, it's bad. 51 out of 52 countries that have hit a debt to GDP over 130% have defaulted. 51 out of 52. The one that hasn't is Japan, and Japan has had an economy that is they're an exporter, not an importer. So we're a huge importing country. We don't make a lot of stuff. Japan does. They make a lot of stuff there. So they're a little different with their demographics, but their economy's been garbage for 30 years. I mean, they hit their peak when we were, either born or super infants, and haven't really done shit since.
Yeah.
So if that's the case for the United States, that's not really a glowing recommendation on what could happen if you do kind of survive and go through that. But yeah, housing is tricky. It's been a hard conversation with clients. I know that anyone on the team chatting with housing, it's just been like, it's rough, and you just try to be patient because it's nutty. And yeah, that swing, how high, how low, right? Like that is a wild, volatile ride at the moment.
Well, that's, I think, what's messing with people is like housing's typically, similar to stocks, or sorry, similar to bonds, is not an asset class that's supposed to be volatile. That's why that was always my argument with like the San Francisco market. It was like, oh yeah, I mean, like I had, friends that made 300K for owning their house for 2 years. Yeah, they won the lottery. They shouldn't have. That's like, there's study after study of like long-term studies that like real estate basically keeps pace with inflation in all markets throughout the world, throughout history. So if it's not doing that, like hundreds of years of history should be a pretty good indication of what real estate should do. If it's not doing that, something's wrong, and it's not a strategy worth betting on, right?
It's almost like the money's broken, Josh.
Well, yeah, I would say that, or I mean, also just but I think it's more of a cultural thing. I mean, that's definitely what I saw, like you see in San Francisco, New York, Boston. It's been just a pure cultural shift there, where there hasn't, not necessarily, I mean, the money is one aspect of it because it's obviously fueled by a lot of tech and free money and things like that. But at the same time, it's also boils down to like, hey, I was at dinner with this person that just made 200 grand selling their property or whatever without doing any rehab, or, because they're a great investor, same like the day traders that get lucky for a year and when everything's going up anyways. So, I mean, that's where I think, we're going to see a situation where a lot of people that have over leveraged on properties in these highly appreciated areas are going to get, again, caught with their pants down, and the expenses are going to go up. Because I know for a fact a lot of people, especially in the Bay Area and stuff, have bought on interest only loans, so they may have, or variable loans, or like things like that, where they, if they're not high right now, maybe very high in the near future. And so I think that's just going to be a factor in that, and layoffs and all the just a typical recession. It's a recipe for a pretty rough ride in real estate. But I mean, I personally think it's going to be a good thing. I think real estate needs to come back down to being an asset class that doesn't really move.
Yep.
And I think that throughout, I think if we get a deep enough cut, I think that's exactly what's going to happen.
Yeah, and the other thing that I would just kind of comment on is there's the largest real estate investment trust that Blackstone has owned, the gated redemptions. And at the company I used to work for prior to doing my own thing, there's a lot of that fund sold to a lot of people, and all of a sudden you can't get your money back out. So again, it's the door, it's the crowd, and there's only one person that can go out at a time, and there's 500 people that are trying to get out. It's a little tricky. There's a long line, and so it'll be interesting to see the dynamics there of, all of a sudden there's this idea of mark to market, which is the stock market every day. Like when it's open, you're going to see the tick up, down, like it prices itself in real time. Real estate doesn't do that. And so the fund can look like it's making money. Oh, but then the asset's sold and it didn't sell for what they thought. And they're like, uh-oh. So now all of a sudden they aren't able to see that, but it'll be interesting. And then the same thing for Starwood, which is another kind of large national property manager. They gated redemptions on a couple of their funds. Same firm I used to work for had a lot of exposure there too, but we'll poke fun at them. Yeah, real estate, housing, investment properties. If we do see a big drop, I think there'll be opportunities. But again, it's one of those things about being patient. Talking about being patient. Love this tweet, which came out again, beginning of January last year, but he's tweeted it before. And I think this sums up Bitcoin perfectly, right? Holding Bitcoin, means getting rich slowly while being in pain 90% of the time. I could change that to means being called an idiot 90% of the time. Like you can enter in whatever you want there. But I think this is really good.
People call you an idiot, but it has nothing to do with Bitcoin.
Yeah, it doesn't have to, right? Like if it's Bitcoin, I've been way dumber for things than talking about Bitcoin. But with that, again, nothing on the reasons on why and all that stuff. We've had those conversations. The reason for wanting to own it doesn't change. One interesting metric that I think is interesting that Lopp shared, so Jameson Lopp and Coinmetrics did this study, is basically that $8.2 trillion in dollar terms, right, was transferred within the Bitcoin network in 2022. So that's about 260,000 per second. So again, there's a lot of value in things where it's being utilized. And I think that's an interesting thing to think about and put in perspective. And that's grown tremendously over time in the use cases and the businesses that are being built. That's not changing. And I think 2023, if we see the similar outlook as 2022, Bitcoin might be really boring, where it just kind of hangs out at valuation that it's at right now and doesn't really change a whole heck of a lot. It's not like it's going to rip and go to 100,000 in 2023. I would be absolutely shocked if I saw a six-figure Bitcoin in 2023. But you never know what happens. Any other thoughts, comments as we kind of wrap up? I think everything I had.
I like the quote about that you had for for Bitcoin. I mean, actually, I think that applies to most investments that actually make you rich. You could substitute real estate. I mean, same kind of thing. Like you were mentioning, like
Amazon.
The best time to buy is when things are not doing well. It's the most painful time to buy, and you could be in pain for a long time before you really see the wealth from that. Like there's a anecdotal story about like the Kennedy family, like where they basically amassed their fortune was in the 1929 crash, where basically I forget his name, but like the JFK's grandfather or whatever was getting a shoe shine, and the shoe shine boy started talking about stocks to him, and he was like, "Oh shit, time to get out." Where sold all his stocks, basically then was patient and bought like at the bottom of the 1929 crash, and next thing you know, they're one of the most powerful families in the world. So I mean, there's a lot to be said for being in pain, whether it's through Bitcoin, through more of my favorite investments was buying small businesses or real estate. But I mean, regardless, I think those out of favor investments that are going to be more primed for the environment we're going into, which I think is pretty clear from this conversation. It's probably not going to be stocks and bonds. It's probably going to be some of these more alternative asset classes, whether it's Bitcoin, whether it's real estate. But once the market crashes, not ahead of that, small businesses, things like that, I think, or managed futures, commodities, list goes on. Now the type of environment we're going into is one that is going to be very non-traditional from what we've had probably the past 30 to 50 years. And I think listeners need to kind of plan their investments accordingly. That if you're sitting in the S&P 500 or a 60/40 portfolio, you're probably gonna need a world of pain, but not in a good way for the next 10, 20 years.
Yeah, see, choice down here. I took it off the screen. This is funny. Let me bring it back up. So it says in Spain, but the S is silent. That's the 60/40 portfolio or Bitcoin in 2022. It's just pure pain. So if you had to summarize an investment thesis for 2023, what would it be? One sentence.
For 2023, patience. Like I honestly don't think there's gonna be, kind of like you said, like I don't think there's gonna be six-figure Bitcoin, and I don't think we're gonna see the bottom of anything. I think as we indicated by our conversation, I think there's a lot of things that are pointing to relatively deep, long recession here. And I think 2023 is going to be a time of looking for whatever opportunities come up and just hedging your bets as much as possible while sort of sitting on the sidelines waiting for opportunities to arise. I think that's going to be a lot of it. And so, I mean, I think that things like long volatility, managed futures, momentum, Bitcoin, I think those are like in commodities. Those are, I don't know if I said commodities or not, but I think those are going to be things that really thrive in this type of environment because they're designed to be sort of the antithesis of a traditional market. And again, I don't think we're going to see a traditional market in 2023. In farmland, if you have the means to invest in farmland, I think farmland's actually probably the best investment anyone can make right now.
Shout out to Acre Trader if you want to check out farmland. There's a good Josh has their swag on. That's an episode that we did with Mike Eisman. Definitely recommend listeners check that out. Josh, that was the longest sentence I've ever heard.
What was my
your reply? I'm just giving you shit because I was like, what would be the sentence for investing in 2023?
Patience was my sentence. And
yeah.
then,
Oh, okay. The qualifier.
Yeah. Then I had the description below my sentence.
Yeah. This is the footer. This is what I really want to say. Got it. Perfect. I just wanted everyone to listen.
Comma,
yeah.
ellipses, period. Yeah.
Yeah, I just want everyone to know that is a very long sentence, but it was not a run-on sentence. All right.
So for the record, grammar was never my strong suit.
You and me both.
But cool. Any closing thoughts from your end, or thoughts, or I guess what do you see as being the investment thesis for 2023?
I think it's survival and grind it out. I think that's the thing. This isn't going to be a banner year where you're like, oh, I feel great about things, but it's going to be grind it out and survive, and there will be opportunities. So I think we see things similarly. And to me I don't know if it's inflation or deflation. I don't want to pick. I want some of both. I want something that can survive both. And there are investments that can do both. And I think that's the key thing at the moment.
Yeah, for sure. Well, on that cheery note, well, no, but in all seriousness, hard times come. It's inevitable with investing. Like I think the reason we're in the predicament we're in now is because we tried to make it all rosy and sunshiny for too long, and now we're paying the piper. But life goes on, investments go on, and there is always opportunity in these time frames. And I think that's just something for everybody to kind of take away from this. Is it looks bleak. It probably will be bleak for a little bit, but that's life. This too shall pass, as they say. But yeah, any closing remarks?
Thanks for listening. Remember to smash like, subscribe, all the stuff that's out there. Share it with a friend. If you think we're completely off our rocker, tell us, send us a note, let us know. You can find us on social media across the spectrum there. But yeah, would love feedback and comments, and thank you so much for listening.
Yeah, ditto that. And we always appreciate feedback and ideas, or things that if there's ideas that we haven't talked about or discussed that you'd like us to touch on, we're always happy to dive into any rabbit hole, as you probably have seen. So well, until next time, cheers, everyone. I hope everyone has a wonderful, happy, and healthy 2023. And we look forward to bringing you more content along the way. Cheers.